Yes, very good.
Okay, go ahead, please.
Okay. Well, thank you very much for inviting me, and my apologies for taking so long to get this organized. I will say that I present a lot to investors and other policymakers, but presenting to students has made me more nervous than any of them by a long shot. So I did struggle a bit to figure out exactly what I wanted to talk about today, and so you'll have to bear with me a little bit. I've structured my presentation essentially to almost provide more of an introduction more than anything else to South African monetary policy and how it fits with a fairly long trajectory of macroeconomic issues facing the country. And I hope that this is just an introductory lecture and that we can do deep dives into some of the specific issues that I try to raise. I basically want to set out a story about monetary policy in the context of how South Africa has dealt with the three really big shocks that have hit us over the last 30 years. So this is very much of a kind of economic history lesson, if you will, but viewed through the lens of monetary policy decisions writ quite large. So I'm going to raise some big issues, and hopefully it will all hang together in the right kind of way, and then we can stop and you're welcome to ask questions. So my first big point that I want to work through is one that is less controversial now, but was very controversial at the time that we implemented inflation targeting in the year 2000, which was just simply that inflation targeting wasn't really seen as an appropriate emerging market policy. So I want to talk a little bit about why South Africa became an early mover in the emerging market space. I also then want to move on to discuss how the global financial crisis, in a sense, reversed many of the ways in which we thought about emerging market policy in the 2000s, and which links to this point about becoming an early mover on inflation targeting. So what did the global financial crisis do to emerging market economies, and South Africa in particular, and what were the repercussions of that for macroeconomic policy? That, of course, then leads us eventually over a few years into the pandemic shock, which is my third shock, which is the case I want to make here is simply that the problems that we experienced in the post-global financial crisis era gave us kind of enough room, a barely sufficient amount of room to deal adequately with the pandemic shock. And I'll show you a little bit of what that looks like from a monetary policy point of view, but also from a fiscal policy point of view. But as we enter the post-pandemic world, we run into some very serious constraints. And so what I'm kind of building up to in my story is the way in which the repercussions of the global financial crisis handicapped emerging markets, monetary policy and fiscal policy, and put many countries, South Africa in particular, in a very difficult set of circumstances in dealing with this post-pandemic world that we're in. And then I want to make a final case for how we think about policy now. And the punchline here is really simply that what we want to do is de-risk the macroeconomic environment and create more policy space. But as you'll see, we're very constrained in how we can think about doing that and what our options are. So let's start off with my first point about South Africa being an early mover in the inflation target space. And the kind of context here is very simply the lessons that we were learning in the aftermath and during the aftermath of the Asian crisis. And the Asian crisis, as you will remember, occurred in the late 1990s. It was followed by a Russia crisis and an Argentine crisis in the early 2000s. And in many ways, that experience had some very strong lessons for emerging markets across the board. But also, even though South Africa was somewhat less hit by it, we also took some very strong lessons from it as well. And the three really important points is just simply that emerging markets needed to think differently about foreign currency policy. So we needed to think about whether or not we wanted a floating currency. We had to think very differently about what kind of policy anchors that we had in place, and in particular, what the role of fiscal policy really ought to be. Now, the float and the anchor speak to in monetary policy, and the fiscal buffers was really about how countercyclical should fiscal policy be when faced with the kind of crisis that we saw in the Asian crisis and its aftermath, which went on for a few years, and what kind of policy settings should emerging markets really go for. And my basic argument here is just simply that emerging markets adopted a set of policies that played themselves out through the 2000s that helped them to weather the Asian crisis. This graph just shows you just very one simple indicator of what the Asian crisis looked like for economies. So we saw very widespread exchange rate depreciation across a wide range of countries. Some of the countries that were hit hardest weren't really, strictly speaking, Asian crisis economies. South Africa, which is that red column, depreciated by about 17% during the crisis. And this was at a time when floating rates were really not the thing, right? These were not conventional for emerging markets. And so the impact of the crisis upset macroeconomic policy across the board. And as you will know, generated some very lengthy recovery processes. So what did the crisis do more specifically for monetary policy? Certainly for South Africa, which had also largely run a fixed exchange rate or a quasi-fixed exchange rate monetary policy, it moved the country into quite uncomfortable policy space. So this chart just shows you the classical trilemma, and when the Asian crisis hit, South Africa sat somewhere in that left-hand policy goal one, surrounded by the red circle, which was something like a fixed exchange rate. It wasn't strictly a fixed exchange rate, but the monetary authority, the Reserve Bank at the time, very actively intervened in the currency markets to try to manage that. And a large part of the reason for that was that the economy was moving away from a position of capital immobility. So policy goal 2 on the right-hand side was fading very quickly away from a capital controlled environment and a closed capital account to one in which capital mobility was increasing very, very quickly. And for those of you who have looked at these kinds of things, you will remember that what that does is it puts you into a position where that fixed exchange rate no longer works. And the Asian crisis was essentially the breaking point for many of our economies in the old style way of thinking about the appropriate macroeconomic framework. In that period, South Africa's foreign currency interventions were very large. On the left-hand side, I'm showing you what the Reserve Bank's international liquidity position looked like. And so what that shows you is that we were borrowing many billions of US dollars to intervene in the foreign currency markets. So before the Asian crisis, few emerging markets had built up large FX reserves. And so we really didn't have anything to use to intervene in foreign currency markets. You had to go on to the international capital markets and borrow dollars to do that. And that's what we did. The conclusion or the result of that wasn't very good. And you can see that on the right-hand chart, where you can see the scale of the Rand depreciation through the 1990s, and in particular, right at that period around 1998, 1999, when we were borrowing the most dollars to intervene in the currency markets. The markets responded to that policy intervention by selling the rand off even harder. So we moved to inflation targeting partly as a result of those policy failures. The basic idea here was to simplify the central bank toolkit, to focus on an explicit inflation target rather than what was in fact what we did, which was a combination of an implicit target with an exchange rate intervention policy. And this chart just shows you it shows you the inflation target range, which is the gray bar there, and then it shows you the nominal repo rate, which is in green, and then the targeted inflation rate, which is in blue, and its outcome over a long period of time. So this chart goes back to 2000, and you can see there on the far left the lasting repercussions of the Asian crisis, the following crises, and what they were doing to the targeted inflation rate. You can see if you move a little bit further to the right, in 2008, 2009, we had another very sharp rand depreciation, which was associated with the global financial crisis. And then we get, after that period, quite a long stretch in which the targeted inflation rate sits at somewhere between sort of 5 and 6%. Before then easing further in the run-up to the pandemic. But I'll come back to those points. But basically, we moved away from a more complicated policy framework to one that was meant to be a lot clearer. There was drama early on. I just referred to it, but I'm giving you another kind of view of it. When we introduced the inflation target, the basic idea was to start with a band of 3 to 6%, which is that kind of pinkish area, and then to reduce it quite quickly, and that's the blue blocks there, from 3 to 6 down to 3 to 5, and then down to 2 to 4 by 2004, 2005. So there was quite a bit of drama around this, and we got quite cold feet. And we put into abeyance the further moves down to narrowing that inflation target in this period. And again, that's a point I will come back to later on. So why do inflation targets, I mean, other than just having an interest rate as your primary instrument? Well, the other big motive was to radically increase monetary policy transparency. So what you wanted to have happen was, even though you had a floating currency and you had these very large movements and you had, in theory, very strong pass-through into your domestic inflation rate, you wanted a lot more transparency to as an explicit part of the policy framework, so that economic agents didn't react to the depreciation by pricing in and pricing up and generating a lot more inflation. So central bank transparency was a critical element to the inflation targeting framework around the world, and in particular in South Africa. At that time, the analysts in the investment banking community in South Africa used to complain and say, well, the governor of the bank in November of 1998 would wake up in the morning and suddenly the interest rate would change, and there would be no explanation of why he did it or what its implication was meant to be for inflation. So we were moving from these very opaque policy frameworks and ways of doing policy to ones that were much more transparent. Now, in South Africa's case, that transparency and that single policy tool worked very importantly with another endowment of the country, which was very deep and liquid financial markets. And what that enabled us to do was to be much more confident about the currency becoming a shock absorber for the economy rather than a propagator of shocks. The left-hand graph just shows you a comparison of what South Africa's financial market depth looks like relative to emerging markets. And I think the important point here to generalize to other emerging markets, and it's something we talk to them quite a lot about, is ways in which emerging markets can improve their monetary policy frameworks by taking steps to deepen their capital and financial markets. It's harder to do than just simple reforms. Unfortunately, it takes quite a lot of time. But South Africa's particular history of a closed financial market meant that we developed a quite large and liquid domestic financial industry, which proved us in very good stead, in particular when we moved to the new inflation targeting framework. And in a sense, this is weak proof, but I'll claim that it's proof anyway. You can see how that played itself out in the right-hand graph, because what those blue lines represent is how non-resident investors started to pump money into the economy at the same time that residents were allowed to take advantage of liberalization and to diversify their own holdings overseas. And what you can see in this graph is right in that middle period, basically running from 1998 through to about 2010, you had these very strong non-resident flows, offset partly by these resident outflows. And so the net international investment position of the economy as a whole on balance improved. And then in the second part of the graph, running from the global financial crisis through to the pandemic, you can see the reversal of these flows. And this is very important because it means that as those blue lines sink below zero and you have non-resident outflows out of the economy, you are getting offsetting inflows by residents who were bringing money back into the economy. So financial liberalization and integration with global financial markets, combined with the inflation targeting framework and a lot more confidence in macroeconomic policy, ends up playing very strong dividends when you get hit by shocks. And this is a point that we can come back to if you like later on. So let me move on now to the global financial crisis. So we saw that the Asian crisis generated a range of reforms that were, generally speaking, highly beneficial to South African macroeconomic policy. But now we get hit by the global financial crisis. And this really does usher in a new era for emerging market policy. And my value judgment on this is that it wasn't a good one. For South Africa in particular, general government finances started to demonstrate very large deficits. You can see on the left-hand graph the way in which the blue and red, so that's revenue and expenditure, were very closely aligned. We ran a couple of fiscal surpluses in that period, and then the global financial crisis hit, and the emphasis was on using fiscal policy to offset the impact of that crisis. And so you could see the red expenditure line continues to rise, even though the economy is not doing very well. This is measured as a percentage of GDP. And that use of fiscal policy to offset negative economic shocks continues up through to the present day. That spike on the right-hand side is when the pandemic hits. But at the same time, the revenue line shows you that even though revenue was growing, it was not getting anywhere near the expenditure line. And so our fiscal position was deteriorating over this time. And the gap between those is the fiscal deficit. And as those are sustained, of course, our public debt level rises. And I'll come back and show you what that looks like. So that's fiscal policy. On the monetary policy side, on the right-hand side graph, I'm showing you the real interest rate. So this is the nominal repo rate minus the inflation rate at the time. And I've circled in yellow this period in the aftermath of the global financial crisis running up to about 2017, when that real interest rate level was pegged and stuck really at negative real interest rates. So both fiscal and monetary policy were pushing back on this negative shock and trying to generate stronger growth. Headline inflation as a consequence trended towards the upper end of that target band. So that left-hand graph, if you see those the average black line and red line, that's headline inflation and core, and that coincides with the yellow circled graph on the previous slide. To just show you that while real interest rates were negative and we were doing sustained fiscal spending, our inflation rate was now hitting the top end of our already wide inflation target and seemed really quite stuck there at around 6% inflation. Where did that put us in comparative perspective? Not really in a great space. The right-hand graph shows you what South Africa's inflation looked like relative to the emerging market median, which is the dark line, dotted line, and South Africa's inflation rate is that red line. And we were in that period well above the emerging market median, which is a place that you don't want to be for various kinds of reasons we can come back to. All of this further encouraged quite a bit of debt-fueled consumption in South Africa. Not South Africa wasn't the only emerging market to experience this, but many of us did. Essentially, the takeaway from the global financial crisis was to try to use monetary and fiscal policy to keep growth going, even though productivity was actually declining. And so this high liquidity environment, low interest rate environment, lots of borrowing shows up as a composition of GDP being much worse than that emerging market median. On the left-hand side, I'm just showing you three variables to demonstrate that. The first one is merchandise imports. South Africa is in the red and the large emerging market average is in the gray. And we were sitting at something like 7 percentage points of GDP higher imports of merchandise. Our consumption level, both for large emerging markets and South Africa, is quite high, but we were about 5 percentage points higher than that emerging market median. And then the real kicker is the right-hand part of that chart, which shows you that our investment rate was much lower than the emerging market median. And so we weren't getting the kinds of growth outcomes that one would have wanted, ideally to boost potential growth, in part because the composition of growth was skewed much more towards consumption than it was to investment. And then, as I mentioned earlier on the previous slide, that turns up as a rise in the debt level, in particular by general government. And I'm showing you that on the right-hand graph. So this is debt held by households in blue, non-financial corporations in green, and general government, which is the red line. And you can see that from the global financial crisis period on, running all the way through to the current period, you get a nearly linear rise in general government debt over that period. So what's going on there from a monetary policy point of view and from an exchange rate point of view? Well, I think the punchline again here is that essentially what's happening is that the inflation target is being observed more as a formal thing rather than a practical thing. So, and one way of looking at that is just to look at how the real effective exchange rate compares to the nominal effective exchange rate. And this is, so on the right-hand side, I'm showing you a comparative graph showing nominal depreciation compared to from 2014 on. and I'm showing you the inflation rate, then the extent of the real depreciation. South Africa is on the far right-hand side of this graph. So not only did we get more nominal depreciation than any of the other countries that I'm comparing us to, we had a pretty large amount of inflation. That's that gray component. And that means that the real depreciation that you would have expected had the inflation target been more rigorously applied is actually much lower than expected. And then we show you that more graphically on the left-hand side, where you get this blue line is the nominal effective exchange rate. And so even though you're getting lots of depreciation, it is feeding through into too much inflation, and that real effective exchange rate stays a lot higher than you would otherwise expect it to do. So that's contributing to this poor growth and investment performance. The upshot is that all of this macroeconomic settings that we had in the period essentially are enabling non-tradable sector activity. So it's not as if the economy wasn't growing, but the composition of it, again, was skewing away from exports and to things like finance, things like the public sector, trade, wholesale and retail trade, which is the yellow. And you can see this on this left-hand graph, where I'm measuring the share of total employment. And what you can see very clearly here, sorry about that. If you start in 1990, which is this column on the left, manufacturing employment was about 20% of total employment. By 2005, that had fallen by about 4 percentage points. And then by 2022, that had gone down by another 5 or so percentage points. And on the right-hand side, part of the reason for that failure of manufacturing employment to sustain itself is that while productivity is falling, that's the output per worker, which is the blue columns for each of these countries, you had a much stronger growth, again, in labor cost per worker. So this is another way, another view of how higher inflation is feeding into the economy through higher prices, higher wages, but not boosting investment and productivity in the way that any emerging market of that period really would have wanted to see. I made the point that public sector debt grew very, very strongly. If we look at that, at public sector spending from the lens of net portfolio investment, so what are non-residents investing in when they're investing into your economy, you can see that those yellow columns through all of this post-global financial crisis period are really dominated by general government investment in this period. Some of this gray bar here is actually investment into some state-owned enterprises, plus a bit into the private sector. But basically, the global financial crisis, the post-global financial crisis period is running from here through to about here. And you can see in the way in which general government borrowing is dominating the inflow of investment from abroad. So we continue to get a lot of foreign savings, but it's piling into public debt rather than private sector investment. So where does this all leave South Africa? And again, this is a comparative slide. Well, not in a great position, frankly. The left-hand chart shows you macro balances amongst emerging markets in 2013. So this was just after the global financial crisis. And again, I'm using it just to illustrate the role of fiscal policy in its response to the crisis and its contribution to the need for foreign savings and how big that is. For South Africa, the fiscal balance was running at something like 5%. You had a bit of a private savings investment imbalance, which contributed to additional current account deficit. and our overall deficit in that year was sitting at negative 5.3%. Not as bad as some economies, but not very good either. And that translated again into more exchange rate depreciation than you would have wanted at a nominal level. And South Africa again depreciated during that year quite a lot and relatively more than others. So the exchange rate float is an important part of the inflation targeting framework, but when exchange rate depreciation is persistent, you need a different kind of macro framework to respond to that, and that's a point I'll come back to. GDP growth for South Africa continued to underperform its peers. Some of this comparison is a little bit unfair. Some of these countries on the far left are countries that are going to grow a lot faster, irrespective of the macroeconomic policy settings that they choose. But we certainly didn't do very well. And even with countries that have a similar structure to South Africa and similar kinds of rigidities and other kinds of structural problems, we were doing pretty poorly in this period also. So this is the average GDP growth rate from 2010 through to 2023. And that's a low number at 1.4%. So what was the analytical kind of underpinning of all of this? How did we start to change the conversation about what macro policy ought to look like? Well, one of the critical innovations, if you will, was to move away from the idea that countries in the post-global financial crisis period could re-achieve growth rates that we saw in the pre-global financial crisis period. So South Africa's growth rate up to 2007, 2008 was sitting at about 4.5–5%. The global financial crisis hit. We got back up to about 3% thereabouts, and then we started to fall. But many macroeconomic policy authorities, fiscal and monetary around the world, felt that in the wake of the crisis, they could get back to these much higher growth rates. And that was seen by estimates of output gaps that were very large and negative. And I'm showing you that on the right-hand chart for South Africa. So these are the evolution of the SARB's own output gap estimates over time. And I hope you can see this, but right here where my cursor is, what you were looking at analytically was that our estimates of output gaps were very, very large and negative in the wake of the financial crisis. And then over time, as new data came in and we updated our estimates, those output gap estimates started to shrink. And you can see that by these subsequent blue lines, light blue lines that are moving upwards towards the zero mark until you get to that red line, which is the backward-looking output gap estimate that we currently sit at. So there was no question that at the time of the global financial crisis, we went into a negative output gap. You can see that quite clearly here. But our new way of looking at this, the new analytical tools that we're using, also showed us that in the pre-global financial crisis period, so this is where I'm looking at here on the left, we actually we're well above potential output, and we were running very large positive output gaps, something that we didn't recognize at the time. Again, those same light blue shaded lines showed us that we thought that our output gaps were positive, but only very marginally so in the pre-global financial crisis period. So what did this mean for policy? Well, it basically just meant that our macroeconomic efforts in the wake of the global financial crisis were actually much stronger and quite some distance from what appropriate monetary policy settings ought to look like. And the key here was the reestimate of potential GDP rates and what they ought to be. And you can see how this has come down very strongly over time. So around 2013, 2014, we started to re-estimate or get much more serious about our estimations of the potential growth rate. And looking back at it using the different methods we used, Hodrick-Prescott filter, and as well as production function methods, we decided that we had the potential growth rate pretty much all wrong. So what's the result of that from a macroeconomic point of view? Well, I indicated that policy settings were much too loose, and you needed to have eventually, as debt starts to rise and your growth rate is falling and you're trying to you're running current account deficit, trying to pull in investment, something has to give, and there needs to be some kind of adjustment somewhere in the economy. It didn't come from the fiscal side. You can see here that net saving by general government remained solidly negative. That's that red line over this whole period. So there was no real effort by the fiscal authorities to deal differently with the macroeconomic outcomes we were achieving. Households in South Africa, like in many other countries, are not very good at saving at all. And so what you saw was a rise in saving really coming out of the private sector. Again, not great outcomes and not great results in this period. You had net savings was positive, but not very strong. And then as you ramped up into the pandemic, that net savings rate starts to rise quite strongly. The result, of course, of this not very good savings rate is that investment never really was able to pick up. And again, I'm showing you on the right-hand graph here just a comparison of what South Africa's investment as a percentage of GDP looked like relative to major emerging markets median. Most other emerging markets did okay in this period. So we're looking here at Brazil and India and China. South Africa, however, had a rather different trajectory, which played itself out in the growth rate. So let me now move to, so how to think about all of this and what to take away from it. This graph is hopelessly confusing, but this goes back to my days as a graduate student, and this is a swan diagram, which I always thought was a useful way of thinking about where you start in your analysis of macroeconomic policy and what you ought to do about it. Just for those of you who aren't familiar with a swan diagram, this just shows you on the bottom axis domestic demand or absorption, and on the vertical axis relative prices. So this is the exchange rate. And a rise in relative prices, so moving up that axis, is an appreciation of the currency. And then you've got two blue lines here. One is internal balance, which is this one running here. And then you've got external balance, which is this one running here. And what you want to do with this kind of tool is just sort of map out, well, where are we in this space? What's our starting point? Are we up here where we're running a current account deficit and unemployment? So you have essentially a overly appreciated currency. Or do you start out someplace like over here on the right-hand side where you've got inflation and a current account deficit? Now, what kind of policy conclusions you want to draw depends a lot on where you fall in this. I'm not going to try to explain all of these little lines here. This was done for a different paper. But in the South African debate, you essentially had two kind of polar positions. The one position was that South Africa was sitting in the place like point A. And so it was acknowledged that you had a current account deficit, so we were spending more than we're producing, and that's being financed by abroad. But you essentially have a very large unemployment problem to deal with. And so the decision you have to make is you want domestic demand to increase by moving to the right, but you don't want to move up towards Z. You want to move down towards D. So you want more depreciation rather than appreciation. So that was one kind of perspective. The other kind of perspective was that you started at a point like C here. And C essentially said, well, unemployment that we have is really more of a function of rigidities in the market. So the unemployment that we see doesn't really put you in this kind of category. You're actually sitting here. Your labor market is actually tighter than you think, which is why you get inflation. Plus, you're also running fiscal and monetary policy a bit hotter than you would like. And so you're not only getting inflation, but you're also getting a sustained current account deficit. These obviously lead to some rather different kind of implications for policy, and I'll talk a bit about what those were going forward. Now, this slide, again, is one of my more hopeless ones. But I'm trying to just make the point here that if you accept the argument that fiscal dynamics had gone wrong in the post-global financial crisis period, then from a monetary policy point of view, you need to try to figure out how to account for them better in your monetary policy thinking. And I won't go through all of this, but just to make the point, that we very explicitly incorporated eventually a set of fiscal measures or indicators into our way of thinking about monetary policy. So this equation just tells you that you want to include in your IS curve a gap between a long-term structural balance that is sustainable and the one that you currently have, which is what I'm underlying here with the red bar. Other elements of the equation are pretty straightforward. You've got an output gap, you've got a real exchange rate gap, you've got an output gap with the rest of the world. And importantly, for a commodity exporter like South Africa, you've got a terms of trade variable as well. But this inclusion of a fiscal set of variables in that equation is a little bit unusual, but it follows from this kind of argument. Because if you think that you sit at C and you think that fiscal policy is contributing to that current account deficit and the inflation rate that you're getting, then you've got to be a bit more explicit about what fiscal policy is doing to your monetary policy settings. Now, why, in a little bit more detail, why is fiscal policy a problem? The conventional macro policy response is, well, you get hit by a negative growth shock, and so it's okay for fiscal balances to do what they're doing on the left-hand side there. But our analysis, as we unpacked the potential growth rate, we asked ourselves, well, why isn't fiscal policy having a better growth impact? And we can get into the detail of why that's the case. But the upshot was that our view of it was that fiscal multipliers were systematically falling. And so even though we were spending more, we were getting less of a bang in terms of growth for it. And our calculation of that fiscal multiplier is what I'm showing you on the right-hand side. Not only is it going down, but it's going down very fast indeed. And so you really are using fiscal policy to push on a string, monetary policy too, as it turns out. You're pushing on a monetary and fiscal policy string to try to get more growth, but you're not getting it. The other complication for monetary policy in all of this is that fiscal policy is generating a rise in the long end of the yield curve. And so that red line shows you South African 10-year bond yields, which are almost in a linear fashion progressing over this period. This is the post-pandemic period. So you have this increase in the fiscal deficits here, and that's you've got a high bond yield before the pandemic sitting at 9 to 10%, and then you go into even larger fiscal deficits, and that pushes up the bond yields even farther. Again, this is in some contrast to a range of other emerging market countries. So the EMBI is the Emerging Bond Index, capturing a more comparative view, and you can see that this went up very strongly over much of this period and then kind of collapsed more recently. So the fiscal position of many of these emerging markets was much better than the one that we were looking at, where we were continuing to try to use fiscal policy to push harder. Now, again, another channel through which that fiscal position impacts on monetary policy, we capture it in that risk premium. So if you just singled out South Africa's emerging market bond index, it would look something like this. It would have stayed much, much higher, and that generates a sovereign risk premium, which we capture in our estimate of what the appropriate domestic neutral real interest rate is for South African monetary policy. So we break that down into three variables. One is the foreign neutral real rate, which is essentially a weighted average of the G3 neutral real rates. We attach to it that risk premium that I showed you in the previous slide, and then we add to it a change in the equilibrium exchange rate, and that gives us, in our monetary policy framework, the domestic neutral real rate. Now, this is quite different from the way it is viewed in many other countries. You will all be familiar with the debate over this in advanced economies. But advanced economies are essentially self-financing. And so what happens there is that foreign neutral real rate falls away, the risk premium falls away, and you can actually just have almost a residual variable here, which is the potential growth rate. And that reflects the work of people like Laubach and Williams, who did the conventional thinking about neutral real rates for advanced economies. The point I'm just trying to make is that in an emerging market environment, you have to analytically or conceptually think of the domestic neutral real rate in rather different ways, which we try to do. It is really hard for us where we sit now to imagine how the risk premium is going to reduce until more tangible fiscal consolidation is achieved. This graph on the left just shows you where South Africa sits against another basket of emerging markets. Not only is our emerging market bond index spread considerably higher than the average, you can see it sitting at about 425 basis points, but it does align with a relatively high government debt to GDP ratio. And part of that rise in the spread is not just the overall level of the government debt, but also its combination with weak growth rates. So the kind of R minus G argument can be brought in there. The G just isn't high enough to help pull R down given the level of debt that you've got. Again, how does this find its way into monetary policy? This is just a graphic representation of the slide before, just to understand kind of the picture that this presents to us. And what you can see again in this global financial crisis period, how foreign R star is falling. So that's the blue line, and it's pulling down the warranted global neutral real interest rate. But then for South Africa in particular, this gray is the risk premium. And you can see that that's rising as government debt rises, and it's pushing up our calculation of the domestic R star, which is that black line. So where are we now? Well, the Taylor rule that we have implies some easing towards neutral. So we sit now here on the left-hand chart at 8.25% with the nominal repo rate. And our current forecast shows that going down over the next 3 years to something like 7.33%. We achieved a very low 3.5% in the midst of the pandemic, or as our part of our response to the pandemic. And we were allowed to do that, if you will, by the fact that inflation collapsed in that period. But that 7.33%, that long run neutral repo, sorry, I'm doing things that are moving my slides inadvertently, is still well above the rate that we were at 6.75% prior to the crisis. So we're sitting still considerably above, almost 100 basis, sorry, not 100 basis, 50 basis points above where we were in the pre-pandemic period. And clearly we want to get to something like that. It's not entirely clear how to get there. Our current real repo level is sitting just above neutral. So here on the right-hand graph, and that's our assessment as the Monetary Policy Committee, is that our policy stance is moderately restrictive, trying to push that inflation rate down. So that raises the question of, well, what else can we really do? And so how do you think laterally about your other options? You don't want to continue to raise interest rates for obvious kinds of reasons, but you need to do something to de-risk the economy and help bring down that neutral real rate that we calculate. Certainly reducing inflation towards emerging market peers would be a step in the right direction. This chart's a little bit hard to just look at and figure out what's going on. So let me walk you through it very quickly. Essentially, you've got three buckets of countries. You've got developed countries on the left. You've got developing or emerging market countries here in the middle. And then you've got another group of developing countries on the right-hand side. And we've scaled these according to what their inflation targets look like. You've got inflation targets sitting at around 2% for advanced economies. For a lot of emerging markets, you're sitting at somewhere between 2 and 4%. And then South Africa's right here. We don't have a dot there, but it's this line here. Our inflation target is that 3 to 6%. And so where we find ourselves from a comparative perspective is closer to this grouping that has wider and higher inflation targets, and further away from this grouping, which has lower inflation targets. So thinking a bit differently about what the inflation target might do for us is useful. There's been quite a bit of good work on this in recent times, in particular by a paper by Hanahan and Orphanides that came out about 1.5 years ago, which gave us some indications of how they thought about our inflation target, which was quite useful. Now, the standard response to even sort of going in the direction of saying, well, maybe we ought to think about a better inflation target, is that the growth impact in the short term is going to be very negative. And so we've done a little bit of work trying to calculate sacrifice ratios over different periods of disinflation for South Africa alone. And what you really find here is that those sacrifice ratios are really actually not very large. The biggest period is in the 1991 to 2000 period, which is here. So this is the amount of disinflation of roughly 12 percentage points. And here was the growth cost. But context matters a lot. And this was a period, again, in which South Africa was running very large current account deficits, very extended fiscal deficits, and for various kinds of reasons, the growth rate was also quite low over that period. More recent disinflation periods, if you look at 2001 to 2004, there was essentially no real growth cost. 2008 to 2010, a little bit more of one there. 2016 to 2019, actually almost no sacrifice ratio whatsoever. So the context does matter. And what the literature tells us is that there are ways of doing disinflation in ways that are more growth friendly. And one of the key things here is just simply that communication, credibility are key to disinflationary periods, because what you want to do is get expectations of future inflation to move in line with any articulation of trying to achieve a lower inflation rate. And the evidence that we have is that South Africa is not too bad at this. So in the graph on the left shows you what happened when we adopted the current forecasting model, the QPM, which coincided with a period when we started to talk about explicitly targeting the 4.5% mark of the 3 to 6% inflation band, and the way in which the analyst community started to react to this. So they picked up on this very quickly. They embedded it in their own thinking and their own forecasts of what future inflation would be. And that's exactly what you want to have happen. That translated again into inflation expectations falling. And you can see that here on the right-hand chart, the way in which analysts in particular incorporated that news right here. And then you start to see both 2-year and 5-year ahead inflation expectations falling. And again, that's exactly the kind of trajectory that good policy making would want to try to achieve. The bump up in inflation expectations on the right-hand side comes from the inflation outcomes of the post-pandemic period rising and pushing up inflation expectations a bit. Again, you can take some very positive view of this, which is just that the inflation expectations, despite this quite aggressive rise in inflation, remained relatively well anchored. And so what you would want to do now is to re-anchor them more durably. Again, credibility matters quite a lot for this kind of an outcome. The policy tightening cycle that we've seen up to now has been quite modest. And again, we take away from that this is a sign that monetary policy and its communication aspect is working reasonably well. The real interest rate levels on the left. I think what's more interesting is to look at the chart on the right, which shows you how we compared in the last tightening cycle compared to other countries. And South Africa sits right here. So our tightening cycle in real policy rate terms was actually very, very mild, even relative to some advanced economies. So what do we want to do? You want to continue to reduce the inflation premium, and you want to encourage fiscal consolidation to help de-risk the economy and to create the policy space that you want. What we're looking at now is, as those inflation expectations went up again in the post-pandemic period, you can see that the inflation premium that's priced in by the markets has started to rise. So that's the blue line. And then you can see the bond spread. So this is the nominal bond spread here remains. This is the gray bar. The nominal terms remains quite high relative to the post-global financial crisis period. And at a minimum, you want to get that bond spread to continue falling. And that, again, I think is a good case for continuing to think about monetary and fiscal policy as part of a consolidation effort rather than trying to go back to that post-global financial crisis effort of pushing on a string. It's not all about monetary and fiscal policy, however, and for the South Africans listening, they will know this, I think, quite well. But I think this point can be generalized to a lot of other emerging markets as well. I'm just showing you a very, very simple aggregate demand, aggregate supply chart, just to demonstrate the point that you're not going to fully resolve your supply side problems or your inflation problem, which is generating that essentially a stagflation bind purely with monetary policy efforts. You really do need to see that that supply curve moving back to the right here. I'm just showing you here what a negative supply shock might look like. Now, if you just try to use domestic demand to boost it, of course, you're dealing with a supply curve that's moved up to the left. So you've had a negative supply shock in the short run. And of course, your long run supply curve is going to remain vertical there. And pushing on the aggregate demand is more likely than not going to generate more inflation and not really a lot of growth, which is, I think, the experience that we've seen across many economies. And to generalize this just even further, even the debate in advanced economies is moving much more strongly in the direction of saying, well, we've really got to actually deal with growth in a different kind of way, less macroeconomic policy per se, and more supply side reforms. And in South Africa, you can magnify that policy recommendation by a factor of 2 or 3 at least. So let me conclude with a few final points. Try to summarize the story I've been telling. Essentially, the Asian crisis macro formula was a pretty good one. It emphasized sustainability. It emphasized building reserves and fiscal buffers and being quite clear about what you were trying to achieve with monetary policy. But the global financial crisis has pushed us quite far away from that macro formula. Part of the problem has been that the global environment has encouraged a loss of fiscal anchors and the dropping of them, because there's been a lot of capital sloshing around the world looking for investments, and governments around the world have taken advantage of that by building up very high debt levels. And most emerging market economies in this period have been very unwilling to tighten macro policy. If you go look back at the debates about the taper tantrum, the 2013 to 2017 macro debates, what you see, I think, more than anything else, is a reluctance amongst emerging market policymakers to try to even go back to those Asian crisis policy settings. There's enough there to manage the pandemic shock. And I haven't gone into it in great detail here, but I think the fundamental issue there for South Africa was that with inflation falling as a result of the shock, it allowed monetary policy to respond. But now we find ourselves in a position where monetary policy is constrained, and we suddenly realize that our fiscal policy settings don't provide any room either, because we've taken advantage of all that liquidity out there to try to get growth using fiscal policy. In this kind of environment, the foreign currency float becomes less desirable. And again, you can see this in the international literature. The IMF talks about this a lot. The whole arguments about the collapse of the trilemma to a dilemma, the arguments about what happens when the US raises interest rates and causes depreciation in emerging market economies, is a function of this kind of idea that floating works under certain conditions very well, but once you start to build up very large deficits, floating often becomes a kind of a weakness. In South Africa's case, part of the story there is that the terms of trade is weak. That would obviously not be the same for many other emerging markets that are commodity importers rather than exporters. But because you have these very large fiscal deficits, you still need to have capital accounts that are open as possible. You want to attract investment, you want to attract capital, but you're starting to try to do that from a very weak position indeed. And that really means that you've got to move a lot more aggressively at the end of the day to rebuild policy space and to figure out how to secure growth through supply side reforms because the macro instruments are just no longer available to you. Romain, thank you very much. I'll leave it there.
Hey, this is great. Thanks a lot. Very, very inspiring. I think you really touch upon the critical point and analytical insight to understand what has happened from the late 90s and early 2000 when you adopted the IT. And I think it was very, very clear what is going on now. We see the debt issue. The currency has been depreciating as well. And you touch upon some structural issues about unit labor cost. The private sector is not investing. And I think these are possibly issues to address at the background, I think, to facilitate, I think, policy making and policy space, as you said. So now we can welcome questions from the floor, from UNamur, from Pretoria, from UCL. Any question? Maybe if you want to ask question, you can just raise your digital hand, and then we will organize. Or from UNamur, yeah. Any question?
You have a question there? Please.
Already one hand from UNamur?
Yeah.
Okay, go ahead.
Okay, thank you very much for this presentation. That we are really happy to follow it. My first question is about the central bank transparency. How this policy is put in place completely, because you explained that it was very key for the successful of monetary policy. And the second question is, you said that the financial sector become now a shock absorber. If it is, it was an interesting point, and I want that come back again to explain more in detail this point. And the last question is the fiscal multiplier. We see that the fiscal multiplier is increasing with time. So we want to understand more what is the reason behind or the mechanism behind this increasing trend of the fiscal multiplier. Thank you.
Okay, so this was a student from UNamur. This is an international program, SMITE, and this was a student from Burkina Faso. So we welcome students from many developing countries. So do you answer first, Chris, or you want to take more? Because he already has 3 questions. One was about the IT, the second one was about exchange rate, and the third one I did not follow. You got the third one, Chris?
I didn't, no. I'm afraid
No.
not. I didn't quite follow that one.
Yeah. Dieudonné, can you repeat the third question?
Yeah, the third question is about the fiscal multiplier.
Fiscal multiplier.
Fiscal multiplier was decreasing in time, and
Okay.
it's interesting to understand what are the reasons.
Okay. Okay. So I propose you try to elaborate on these questions, and yeah.
So just what, and the first question was about what? The inflation target itself.
Yeah.
Yeah.
What about it? Why the target? I didn't quite hear that one.
No, it was about, you said that the transparency, the central bank transparency is important for the inflation target. And you see our countries, we don't have a really developed central bank. So we want to know how this transparency is working completely.
Okay.
Okay.
Yeah.
Okay.
Yeah, great.
Yeah.
Thanks very much. Those are great questions. Thank you for repeating them. So let me start with the last one first on the fiscal multiplier. Look, I wouldn't expect you all to follow the intricacies of South Africa's economic trajectory or current news and debates. But essentially, one of the things that we've seen in the country is quite a lot of corruption and a lot of wastage of public resources. And so, it's always difficult to measure productivity of the public sector anyway. But broadly speaking, we've seen more spending and less contribution to growth over time. And the reasons for that have to do in part with weak policies. Part of it has to do with corruption and wastage. Part of it has to do with quite a lot of funding spent on infrastructure and investment that didn't generate the right kinds of outputs for various kinds of reasons. Some of the infrastructure was targeted at the wrong things. Much of it wasn't completed in part because of corruption. So that's part of it. The other part of it is just simply that you should see a private sector response to government spending. That is the standard link between government spending and growth in the economy. It's not just government's direct contribution, it's the way in which the private sector responds to that. But if your infrastructure investment is not doing what it ought to be doing, and you have quite a bit of wastage and or corruption, you're not getting a direct financial flow from government spending into the private sector. And then secondly, you're getting a very weak confidence response. So the private sector isn't saying, well, we will invest more on top of government's investing in Project X. They say, well, we're not really sure what Project X is going to deliver, and so we're not going to invest either. And so there just really hasn't been a very elastic response by the private sector to government spending. And those all are captured, I think, in that fiscal multiplier estimate that we've developed, and as you saw, falls dramatically over the 10-year period. On the shock absorber, again, these things are often very conditional on your economy, and conditional in particular on the way in which the private sector responds to shocks that hit the exchange rate. I think that the textbook, what you want to see is that you have a negative shock, you get a depreciation of the exchange rate, and you go through a J-curve trajectory. And so you end up with a composition change away from non-tradables consumption and production to tradables production and less consumption. And so that's what should happen when you get a depreciation. And when I say the shock absorber effect works, when we look back at South Africa's experience, you see that kind of thing playing itself out. What weakens it is the inflation response. So when you get a nominal exchange rate depreciation, if it doesn't generate a real exchange rate appreciation because inflation rises, then you're not going to get that J-curve effect, right? And so my argument is that shock absorber starts to dissipate over time as inflation starts to rise. Now, other emerging market economies or other economies will behave quite differently. In many economies, when they get a depreciation of the currency, they get an automatic large contraction in economic activity. And that comes through a couple of different channels. One is just simply that the domestic economy tends to think about their wealth and their consumption opportunities in foreign currency terms. So when their local currency depreciates, they are poorer and they react to that by consuming less. That's part of the J-curve effect. But in some economies, that effect is very large and is magnified. And for many of those economies, often the same kinds of economies, they have borrowed a lot in foreign currency. And so they also get a negative hit from a rise in the borrowing costs. So now they're trying to pay back a foreign currency loan using a depreciated currency and depreciated currency earnings. And that's where that literature by people like Gita Gopinath and others comes from, where they look at that, how large that effect is. But you have different types of emerging markets, and South Africa is very much on the former end and not so much on the latter. Our foreign currency liabilities are very low because our domestic borrowing is not in dollar or euro terms, it's in rand terms. So you don't get that negative impact coming through borrowing when the exchange rate depreciates. On the other side of the shock absorption is an appreciation. So again, if you think back to the debates about emerging market policy in the post-global financial crisis period, many countries complained about appreciation of their currencies. Now, the reason why their currencies were appreciating was twofold. One was that they were often commodity exporters, like South Africa, like Brazil, but also because they were running a large investment savings imbalances. And so they were because of their macro settings, they were encouraging portfolio flows into their economy. And both of those factors were appreciating their currencies in uncomfortable ways. And that generated a whole industry around, well, how can we intervene to reduce returns to foreigners? How can we intervene in foreign currency markets to stop this from happening? And my submission to you, and was something we can go into in much more depth in another time, is that those policies didn't work very well because they were fighting against essentially macroeconomic policy settings in the emerging markets, which were appreciating the currency faster than any of those interventions would have actually worked. So the shock absorption function on the appreciation side just didn't work very well. So how would it work best? You would have a rise in your currency, and that would send the signal to people who want to buy your currency tomorrow. It would say to them, well, the return on that currency is not going to be very good, so I'm not going to buy it more, right? That's the way I think the market ought to work. But what was actually happening was that you were getting herd effects, and you were getting very strong inducements to continue buying the currency. And so for some countries, that shock absorption just didn't work at all. And in South Africa's case, it worked a bit, but not terribly well. And then finally, on the transparency issue. So, I think the way this is meant to work is just very simple. You have two forms of credibility. One form of credibility is a kind of German form, right? So everybody knows that with the old Bundesbank, that if inflation rises, the Bundesbank was very happy to put the economy into recession to ensure that inflation doesn't rise, right? So that's one very hard form of strict inflation targeting credibility. But there are softer forms, and those softer forms give rise to the idea of flexible inflation targeting. And what that really is about, in part, is about using communication. So it's about being credible, but it's about telling the market and economic agents what you are going to do. So are you going to look through a current bout of depreciation of their currency because you are focused on an inflation target that you are confident you will re-achieve in very short period of time? The more confident you are about that, and the more you communicate about it in sensible, credible ways, the more economic agents do not react to the exchange rate depreciation. They are confident that you will actually get back to the inflation target. And so they don't have to protect their real income levels by raising their own prices. And so that transparency in communications becomes a really critical part of trying to be a flexible inflation targeter. Where that breaks down, then you can't be as flexible, right? You have to move into the more strict category of inflation targeting.
Yeah, so thanks a lot. I think one important takeaway from all these related point is that the fact that South Africa has a very developed domestic financial market facilitate also the implementation of IT, because the SARB is focusing on inflation, and you don't have to worry much. And this is under quote about some big depreciation, because the debt is in a local currency, so you don't have to worry much about it. I think other countries like Ghana and Kenya, which is moving a little bit in that direction, I think they are facing some difficulties because they don't have such a domestic developed financial market. Yeah. So can we take more questions from the floor?
Do we have some more questions, guys?
Yeah, I see some hand from UP. Sibusiso, please, you have the floor.
Okay, thank you. My name is Sibusiso Ndlovu.
Yeah.
Chris, my question is based on the inflation rate target here in South Africa. Maybe I missed it, but I just want to get a background. Now, when you see the target for a developed country, it says around 2%. Then South Africa is 3 to 6. What is the reason for actually setting it between 3 and 6? Because if you check other things, they say 2%, and maybe it speaks to your conclusion that says emerging economies are not willing to tighten their monetary policy. So what is the reason about it? Thank you.
Okay, this is a very, very critical question, and we have heard a lot about this debate from the global financial crisis. So I leave the floor to you, Chris, to answer to that question, please.
Right. Well, I wish I could give you a purely time-consistent answer, but what I would tell you is that when we implemented inflation targeting, we were nervous about it, and we were sitting at an inflation rate somewhere around 14-15%, and we were seeing all of these shocks. So part of the debate was, what kind of inflation target can we put in place that would be credible for us as an emerging market in an environment where very few other emerging markets had inflation targets, and what kind of target would look credible given the circumstances that the world was going through at the time, and what would be domestically palatable from a political point of view in an environment where the collective bargaining system, so the wage determination system, was routinely generating nominal wage growth of 7, 8, 9, 10%. So, what kind of inflation target could you put in place that would get both businesses and unions to ratchet down to a more sensible sort of inflation rate plus productivity? So those were the kinds of considerations that we applied ourselves to and had to think about. And the 3 to 6% was meant to be an initial 2-year stage, and then we were going to move to 3 to 5, and then something like 2 to 4. So the idea of moving to a narrower range was very explicitly part of what we wanted to do. For the reason that you're getting at, Sibusiso, which is just simply that there were advanced economies that looked like they were targeting around 2%. There were a handful of emerging markets that were targeting somewhere around 3 to 4%. But we were quite conscious that if inflation is essentially a tax on the economy, and in the long run, you wanted to get to a lower rate. So in a way, 3 to 6% was kind of a step, a way of stepping from one down to the other in what we thought would be a credible way. Was it the right way to do things? Probably not. And I think we really asked ourselves some very hard questions in the wake of the global financial crisis when we got back up to 6% inflation rates. About, well, was that wise not to have revisited the initial narrowing of the band in the 2000 period? And the conclusion was that it was a big mistake. And so that's why we moved in 2017 to say, well, let's go for 4.5%. So let's pick the midpoint of the 3 to 6% target and say that that's what we're really aiming for now. And as you will know, we've raised the question again now, whether or not we shouldn't be reconsidering the 4.5% to narrow it further. And I certainly encourage you to go find the Honohan and Orphanides paper, which was a paper that was commissioned by the National Treasury to look at this issue in South Africa. And you may or may not know, Patrick Honohan, who's an ex-governor of the Central Bank of Ireland and worked in the World Bank for many, many years. Athanasios Orphanides was the central bank governor of Cyprus. He teaches at MIT. He was at the Federal Reserve for many years. So it was very hard to imagine two better qualified individuals to give us advice on this. And their conclusion was unambiguous. They said, you are now an outlier. That in its own right carries a cost. The fact that you're having inflation coming out above that international norm is an additional cost, and so you really ought to do something about that, which as a central bank we agree with. So that's it's a long story. We could talk about it for a long time, but essentially that's how the thinking went and how we kind of progressed over time around that. Romain, I've got time for one more question, but unfortunately I've got to run. So thanks.
We have time for one more question. Otherwise, I may ask that question. So I was wondering about what structural reform that may be needed to address the growth issue in South Africa. It seems obvious to me to start the private sector, for instance, reform in the labor market to reduce the unit labor cost. It seems that something is going there. But possibly, I think you touched upon also the point to improve efficiency of government spending. And this is a political and technical issue. How do you see this kind of reform space in South Africa?
Right, I dropped that slide from my presentation because I thought it was too much. So just very briefly, I think the structural reform questions are difficult without any doubt, and they're always difficult in every country because they have distributional effects, and there are incumbents in every industry that are hard to shift. They never like competition. So, you've got to figure out ways of enacting reforms that get through that kind of political economy set of problems and are likely to generate the right kinds of results. As you say, there are kinds of reforms in the public sector that would be very useful. There are reforms in particular in network industries where South Africa has large state-owned enterprises which from a regulatory point of view dominate in those sectors. And so there's not a lot of competition and there's no requirement for them to purchase from private providers. And so they're quite inefficient, and their inefficiency has worsened over time. The energy sector is the primary example of this, but that's also true in the transport sector. It has in the past been true of the telecommunications sector. So, opening up those sectors to private sector competition, I think, is a useful way of getting better growth rates, and I have no doubt that would have both direct and indirect knock-on effects into private sector investment. And then the third basket of reforms, which is one which is in a sense more difficult and has been there for many years, is South Africa's product markets are not particularly competitive. You have very large players. You have a regulatory environment which makes it very difficult for smaller players to either enter or compete. So you would need to do quite a bit of reforms to get better outcomes there. And then the labor market's the other one. I mean, to be blunt, South Africa has a labor regime which makes it very hard for unskilled workers to sell their labor into the market, and that keeps the unemployment rate very high. There's obviously a big structural skills problem, which exacerbates the problem. But there was just an article today, which was very telling, in the Business Day, a newspaper here, which talked about the way in which in the steel industry, the fixation or the focus on wage determination starting at the bottom entry-level wage compresses the wage structure of industries in ways that lower productivity and very deliberately make it very hard for entry-level workers to find jobs in these formal sectors. And that's true in many of South Africa's industrial sectors. So the collective bargaining system is not very efficient and certainly not very focused on job creation. So in all of those areas, you could get a lot of growth bang for the buck if you tackled reform there.
Okay, thanks a lot for your excellent talk. I think we learned a lot about the South African economy, about policy making. Nicola, Julia, you want to say anything? Yeah.
Thank you very much. You have done a lot of my lecture for me. That's excellent. Thank you.
Yes.
Class.
I'm very grateful. I think you touched many interesting questions, and I'm glad that we talked about many of them also during our course. So I think it was very nice compliment. Thank you very much.
Thank you very much for having me.
Yeah, thanks a lot for all students. We will repeat this thing hopefully next year. See you around. Bye-bye.
Bye-bye.
Thank you. Bye, see you in class. Ciao. Romain, if you can send the video so that I can distribute it among the students.
Okay, I will.
Thank you, Romain. Thank you, Julia. Thank you, everybody.
Thank you.
Bye-bye.
Bye-bye.
Bye.